Robschild, not investment advice. Welcome to the show where we view financial markets through crystal ball gazing. Gareth Soloway once said, "Nobody has a crystal ball," and so we begin. Today is Monday, July 29th, 2024. In today's episode, I wanted to start by mentioning that today is a very big earnings week. Already we had today McDonald's coming out with earnings that were lower than expectations, and yet the stock went up anyway. Interesting. I guess the market was pricing that in. Reading into it a little bit, McDonald's is admitting their prices are too high and customers are running out of money, and we're just at that part of the cycle. I've been talking about on the show, and you've probably been hearing a lot. Company after company is saying, yes, people are, closing their purses. The consumer is getting squeezed, as is expected at this part of the business cycle. Later this week, we have pretty big market cap companies like AMD, Microsoft, PayPal, Boeing, Meta especially, Apple especially, Amazon. Lots of companies coming out with a lot of earnings this week, and I don't really like to look into earnings too much, but it can add volatility to markets. It can send them going way up, it can send them going way down. Theme of the day, mostly bear flags. I said in yesterday's show how mostly it looks like markets are kind of suggesting buy the dip here. I might have a level that might be a buyable dip, but I'm not going to be buying it myself. It's the whole market's too dangerous for me right now, considering the PE ratio of the market cap weighted S&P 500 index and where we are in the business cycle. We're headed into cuts, guaranteed now, with 100% certainty, according to the markets, for the first cut to start in September. For July's rate decision, it will be on Wednesday. It is priced in that there will be no cut for July. That's pretty clear in the data. And it would be highly, highly unusual for Jerome to go against that. I wanted to mention, so tomorrow, Meta earnings after the close, especially big company, big earnings going on there. Thursday, Amazon earnings after the close. Friday is the biggest thing of the week with unemployment coming out. As you might know from watching my show, this is the most important metric to me. This is how many people are out there. Out of 100 people, how many people want a job and can't get a job? That number has been skyrocketing lately. It's still low. By historical standards, we're at 4.1%. The question is, are we going to stay flat as it's expected, as analysts are predicting, or are we going to be ticking higher from here? Friday, huge number for unemployment. Also, daily reminder, the 2-year, 10-year yield curve inversion is still past its second birthday. Historic times. This, to me, signals that we are headed into not just a recession, maybe a really bad recession, or maybe even a depression, but we'll see. It's not like anybody's got I do have a crystal ball. Taking a look at SPX, the S&P 500 SPY, whatever you want to call it, on a daily time frame, these are daily candles here. It's pretty obvious pattern here that we have lower high, lower low, lower high, lower low. Patterns like this tend to continue until they don't. And when might we get at least a short-term bottom? Well, from my crude trend line analysis, if you take the high from March and go to the recent high in the S&P 500 and you just drag it down to this point here, there's going to be a big psychological level right here around 5,340, about somewhere on there. So my expectation is that this current move up is a bear flag or a dead cat bounce, and we will at least get to this line. This line could definitely act as a support to get back up to the upper range of this channel, or this could be it. This could be the big crack that myself and many other market analysts are sort of predicting here. This could be the big move down, especially considering the VIX futures curve is expecting a lot more volatility going into October. Company after company has been reporting, has been basically screaming, the consumer is running out of money here. The cost of borrowing money is higher. Companies can't earn as much money, so the value of stocks, on an intrinsic level, seems like that it will be losing value here. Again, with the seasonality of October coming up, it seems to me that all stars are aligning for maybe this to be the big crack that we've been expecting for, as long as 2 years now. So, but we'll see. Just to bring up the VIX futures curve again, and just notably, the October is higher than the next 2 months. Normally you want lower, curving up. October is elevated. So, this could be a much bigger correction or the beginning of a bear market even. It would make sense for this to turn into a bear market now. No fear in junk bonds, HYT, one of my favorite leading indicators today, still nothing. Well, I've been saying about how, I thought this was the big break in April when you saw these huge red candles. I thought that was it, that this was going to crash. Instead, we bounced right, just rip your face off rally to the upside, and then consolidating so tightly here. And, I've been saying on shows, and I'll repeat this until I see evidence of some other pattern developing here. It will either, the longer this goes sideways, the more potential it has to break higher or lower. And for it to break higher would be extremely unusual considering that credit spreads are so low. I know I've been repeating a lot of these same things on every show, but they're very important. Again, for now, the institutions, the people that have high yield corporate that are looking at the companies that are borrowing their money and saying, oh yeah, you guys can totally pay us your coupon payments and you're not going to go bankrupt. No bankruptcy in sight right now, is what the junk bond market is saying. In fact, quite the opposite, with yield, the credit spread being so tight here. Very interesting time. I think that part of this might be certain entities taking on higher risk for higher yield, considering higher risks in other areas, perhaps. And that's kind of what might be holding this up. I saw someone else's show talk about this too, how there are institutions that have to get certain return on their capital, and so especially with rates going down on treasuries, if they want to keep that yield coming, it can actually get them into riskier assets, unfortunately. The fear and greed index from CNN, bordering on fear, but we are still in neutral zone. Supporting, oddly, the riskier part of the market looks more bullish here, similar to what's going on in junk bond. This is IWM, the Russell 2000. I mentioned how we had a fairly good-looking bull flag here that we broke out of, and I said that how your professional traders will wait till it goes back down to this breakout line before buying and then expecting it to go higher. It's very interesting how there's sort of a rotation here going on from what's normally a more conservative investment, the S&P 500, being bearish, while normally a higher risk assets are showing strength. be careful out there, folks. Very similar to the S&P 500, the NASDAQ has a very calculated looking bearish channel going on here, and so there you can figure out all sorts of trend lines that it might bounce off of and get out of this pattern. But for now, this is the pattern, and the trend's your friend until the end, whenever that might be. That's all from me and my crystal ball. Hope you enjoyed watching. Thank you for watching, and see you next time. Robschild.